The money didn't disappear with a robbery. No masked man. No broken door. It moved quietly, through systems you never see. Your bank balance didn't crash. It adjusted, and most people won't notice until it's too late. Right now, banks in the United States are letting artificial intelligence make decisions about your money. Not in the future. Not as a test. Right now. Loans, fraud flags, account freezes, interest rates. More of it is being handled by machines than most people realize. And that's where the uncomfortable part begins. Because when a human makes a mistake, you can argue. You can complain. You can escalate. When an algorithm decides, there's often no one to argue with. This matters now because banking quietly crossed a line. For decades, computers assisted humans. Spreadsheets, calculators, risk models. But around the early 2020s, that balance shifted. Banks stopped asking machines for advice. They started letting machines decide. Not because AI is smarter, but because it's cheaper, faster, and never gets tired. Hear how it actually works. Every time you swipe a card, transfer money, or open an app, data is generated. Thousands of tiny signals. Location, timing, behavior patterns. On their own, they mean nothing. But AI systems don't look at individual actions. They look at patterns across millions of people. The system isn't asking, is this person trustworthy? It's asking, how similar is this behavior to past outcomes we didn't like? That distinction matters, because similarity isn't guilt, and correlation isn't intent. But AI doesn't care about intent. If your behavior drifts too close to a pattern linked to fraud, risk, or loss, the system reacts instantly. This is why some people wake up to frozen accounts with no warning. No crime, no explanation, just a message that says, we're reviewing your activity. What's really happening is simpler and colder. The system decided your account wasn't worth the risk. And here's the part banks don't advertise. These systems aren't optimized for fairness. They're optimized for loss prevention. If freezing 10 innocent accounts prevents one expensive problem, the math works. For the bank, not for you. This is where the irony kicks in. AI is sold as objective, emotionless, neutral, but the data it learns from comes from human systems, human incentives, human mistakes. If certain groups were historically flagged more often, the model learns that pattern. Not because it's racist, not because it's evil, because it's efficient. And efficiency doesn't care who gets caught in the process. Now zoom out. It's not just fraud detection. AI increasingly influences who gets approved for credit. At what rate? Under what conditions? Two people with similar incomes can get very different outcomes. Not because of a clear rule, but because the system predicts one of them is slightly riskier. You'll never see that prediction. You'll just see the result. Higher interest, lower limit, denied, and the explanation will be vague by design, based on a variety of factors. That's not an answer. That's a wall. Support agents often can't explain it either. They don't see the model. They see the output, which means no one you can talk to fully understands why the decision happened. That's new. In the past, power was centralized in institutions. Now it's embedded in systems. Invisible, automatic, and constantly learning. Banks love this because it scales perfectly. One algorithm can replace thousands of judgment calls. Mistakes are written off as edge cases, acceptable losses. But from the customer's side, those edge cases are real lives. Rent due, bills unpaid, stress compounded. And here's the quiet trade-off most people never agreed to. Convenience in exchange for opacity. We got instant transfers, sleek apps, and frictionless payments. In return, we gave up visibility. You don't see how decisions are made. You just feel the consequences. To be clear, this isn't a conspiracy. It's incentives. Banks are regulated on outcomes, not processes. As long as losses are controlled and rules are technically followed, the internal logic doesn't matter. And AI is very good at producing acceptable outcomes, even if the path there is messy. So where does that leave you? Not powerless, but not in control either. The most dangerous part isn't that AI touches your money. It's that most people don't realize how much. They think banking is still a human system with digital tools. It's not. It's a digital system with human customer service layered on top. And that gap is growing. In the coming years, more decisions will happen faster, with less explanation. Not because banks are hiding something, but because the systems are too complex to explain cleanly. That should make you pause. Because when you can't see the rules, you can't adapt to them. And when systems quietly decide who is risky, the definition of safe starts to matter a lot. So here's the question to sit with. If an algorithm decides your financial future based on patterns you'll never see, who are you really banking with? A company or a machine trained to minimize loss at any cost? That answer isn't settled yet.